I'm Brad Smith alongside Rochelle Akufo. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking some early session volume and bringing you today's top market themes, plus elevating Yahoo Finance's most popular newsletter.
That's right, Brad. We've got a packed show for you on this Monday morning. Futures taking a breather this morning following the S&P 500's historic moves on Friday, closing above 5,000 for the first time ever. And better than expected corporate earnings driving the market's momentum these last few weeks. Investors, of course, hoping to see a repeat this week with results from Airbnb, Coca-Cola, Marriott, and DraftKings, among others.
Plus, markets keeping an eye on a fresh read on inflation. We'll get you the newest CPI print Tuesday morning. So let's get right to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Josh Schaefer, Inez Ferre, and Jared Blickery have more.
Hey Brad, futures seeing a slow start this morning following Friday's closing bell excitement. Wall Street celebrating the S&P 500 closing above 5,000 for the first time ever. The three major averages logging a positive week for the 13th time in the last 14 weeks. This coming on upbeat corporate earnings, which have helped drive momentum in markets these last few weeks. And this week, we'll see that again with 15% of the S&P 500 companies set to report results.
And oil rivals are teaming up, with Diamondback Energy announcing that it will acquire Endeavor Energy Resources for $26 billion. The deal would value the combined company at over $50 billion. This is the latest in a slew of consolidation moves in the U.S. Permian Basin.
And legal troubles mount for Tesla CEO Elon Musk. A California federal judge on Saturday ordered Musk to comply with an SEC subpoena to testify again in the agency's investigation over his 2022 purchase of Twitter, now called X. The billionaire called the request harassment. Musk has 1 week to settle on a date and location for testimony after failing to appear back in September.
The S&P 500 closed above 5,000 for the first time ever on Friday, as the index is on pace to report a second straight quarter of earnings growth. Here with more on what Wall Street has to say, let's get to Yahoo Finance's Josh Schaefer. Hey, Josh.
Brad, yeah, we did it. We did 5,000.
Just like we drew it up, right?
Yeah, we talked about it on Friday morning. We talked about it on Thursday morning. We were talking about it all of last week, and we did finally close at that mark. And I think one important thing to point out with that we had sort of been chatting was, well, there hadn't been a lot of bad news or news that investors wouldn't like, right, to really bring stocks down. I think this week might bring different challenges with that CPI report that we have tomorrow. It's not really just earnings this week, but it has been, over the past week or two, really a string of relatively decent earnings. It's been mixed earnings when you think about it broadly, but when you take a look at how the S&P 500 is doing on an average basis, we're over 2% now on earnings growth for the S&P 500, and we're starting to see more breadth for earnings too. That's something strategists are starting to highlight, that it's not just, the top 7 companies. You see this chart here, this is from Deutsche Bank. That purple line you're looking at is the breadth, the amount of companies we're seeing beat earnings expectations. And the blue line is what the median is. So the U.S. clearly outperforming the rest of the world here, Rochelle, but also outperforming ourselves in what we normally see. And I think that's probably speaks to that strength a little bit.
And we know that investors have gotten ahead of themselves before this. So then as you look at some of the sentiment that you're seeing about monetary policy, does it hold as to where we should be seeing the S&P heading right now?
Yeah, I think it's interesting, right, to think about what are the expectations right now, right? And I think one thing that is expected is for inflation to keep falling, right? And I think that, Rochelle, maybe is you talk about people potentially maybe getting over their skis. Does a slightly hot CPI report shake markets, right? Because it seems like we're definitely going to have a soft landing narrative, everything's fine. Inflation's just coming down in this straight line now, right? And the economy keeps doing well. So I think any blip that you see in an inflation print, at least in the short term, is going to mix up the narrative a little bit here right now, because it seems like most people consensus has written off, all right, inflation is higher than the goal, but it's headed in that straight line to the goal. I think any blip there will be something to watch for sure.
And I think they thought we were going to see that with those BLS revisions. Didn't happen, so at least for now,
exactly.
keeping some hope alive there. Also want to bring in our very own Inez Ferrer as well. We're watching shares of Diamondback Energy after the energy giant announced a merger with Endeavor Energy Resources, valued at over $50 billion. Now, this is the latest in a slew of deals for the energy space. Yahoo Finance's Inez Ferrer has the details. Inez, what are you watching?
Yeah, Rochelle, and I've been watching Diamondback Energy. The stock is down more than 1%. But look, the company announcing that it is going to acquire Endeavor for $26 billion. This is the latest really in a slew of consolidation moves, especially when it comes to the U.S. Permian Basin. This is a $26 billion merger in a cash and stock deal. Just to give you a little background, Diamondback Energy, it was founded back in 2007. It started to trade publicly in 2012. Its market cap is around $27 billion. Endeavor dates back all the way to 1979. It became Endeavor back in 2000, and it is a privately held operator. And in fact, both of these companies are headquartered pretty much across from each other in Midland, right across the street from each other in Midland. That is basically the heartland of the Permian Basin. And it's important, we're talking a lot about the Permian Basin over the last year because we have seen these deals. We've seen Exxon Mobil acquiring Pioneer. We've seen Chevron announcing that it's going to be acquiring Hess, Occidental with Crown Rock. And the Permian Basin has traditionally been more fragmented, but now it's becoming this consolidated space as companies are securing sites for the future. They're securing their drilling sites, and it's a area that has had a lot of technological advances. So it's much more efficient drilling and it's much more cost effective. And these are big players now that are coming to the forefront as we have seen this string of consolidations.
Yeah, and in all of these consolidations, they're talking about what the synergies are. Is it clear when some of those expectations, when they're talking about capital allocation and land synergies and operating cost synergies, when that's expected to come to fruition?
Yeah, look, I mean, this is going to be closing in the fourth quarter as far as this deal is concerned. But just to give you an idea of the combined, when you're combining these two companies that is now going to be valued at around a $50 billion company, it's going to be substantial. They're going to be producing 816,000 barrels of oil and gas a day and a total of 838,000 acres of Permian land. So it's substantial. I mean, you are starting to see a lot of these bigger players going after these smaller players, gobbling them up.
Indeed, a very lucrative, I believe it's the world's most productive oil field there in the Permian Basin. Appreciate you getting us up to speed, our very own Inez Ferrer. Mm-hmm. Well, shifting gears, looking at Tesla CEO Elon Musk back in the legal spotlight. A California federal judge on Saturday ordered Musk to comply with an SEC subpoena to testify again in the agency's investigation over his 2022 purchase of Twitter, now X. Now, the billionaire called the request, quote, harassment. Musk now has 1 week to settle on a date and location for testimony after failing to appear back in September. Now, this comes as Musk reckons with another legal battle in Delaware over his invalidated $56 billion pay package. Now let's take a look at shares of Tesla. They have been slipping of late, down 20% so far this year as demand for EVs slows and the company faces increased scrutiny over its AI plans. Here with more legal reaction is Eric Talley, a professor at Columbia Law School. And on the investment side, we've got Craig Irwin, Roth Capital Partners Senior Research Analyst. A big welcome to you both. So, Eric, I want to first start with you because when we're thinking about potential sanctions and consequences here, the ones that will affect the company the most, which are the ones you think are the standouts here?
Well, the biggest one really pending is this likely appeal of the invalidation of Mr. Musk's $56 billion compensation package. We're going to see how that plays out. There are multiple routes that it might take, but that really has been sort of the biggest news from a financial perspective. The violation missteps associated with the order this past weekend are a little bit more minor in nature, but they could balloon up into larger implications depending on how Mr. Musk responds to this most recent order from a court.
And then, Craig, from your perspective, I mean, with all of the back and forth that Elon has had with the SEC over years, the different legal implications of just how he's run the company and how he's been a vastly different CEO than perhaps many or any that we've ever seen before. Now, with this latest thread where he's trying to figure out if he can move the company and he's got to testify in another SEC probe, how is that likely to trickle through to shareholders at all or impact them?
So the Twitter news over the weekend is really just a distraction, right? For a period of time, Twitter was a major distraction for investors in Tesla. I affectionately called Twitter a boat anchor, a $44 billion boat anchor for Mr. Musk, as it was really squeezing valuation in the stock and, having people ask more questions about how engaged he really is with Tesla. I think he's done the right thing and sitting down for 2 depositions already. I don't see a good reason that the SEC keeps coming back for more and more. They will have knowledge of what that is, but another 4 hours, wow. He really just needs to focus on Tesla, what's going to get Tesla growing, get that mini car to market, get India productive as a market. These short-term distractions that delete days off his calendar are really just unfortunate and not productive for the overall execution.
So, Craig, just to follow on that, because usually when people think of Tesla, they're really taking the long view. But some of these issues, when you mentioned competition in India, of course, competition from China as well, can they still compete? Can investors still look at Tesla as something to look at long term, as perhaps some of their competitive edge starting to wean away when you look at what's happening with EV demand?
Oh my gosh! I mean, BYD's already overtaken them, right? So the competitive edge is being severely eroded. There's a lot. This is a hopes and dreams stock, right? People, don't really look as much at the fact that it's really about the cars. The people that are long this and trying to accumulate shares, even though it's going down, are looking at AI and robotics. But his robots are state of the art for 2014, right? And AI, Musk is threatening to put it in another company. So I just, I have a hard time with the stock. I think there's a lot of exciting things going on in EVs, and Musk deserves tremendous credit for basically creating the market. There was a lot of pushback from others. But the trajectory here is tricky for Tesla. It needs as much attention from Mr. Musk as possible. He is a highly talented executive, and I wholeheartedly agree with him pushing back on the SEC, trying to delete days off his calendar when he needs that time.
Certainly. Eric, would love to bring you back in here. As you think about the legal aspects of all the different arguments that Elon Musk has to make in any of these appearances or in any of his defenses, what is perhaps the most pressing one that he will need to make to ensure that he's still able to balance time between X and Twitter and balance time over at Tesla, as Craig was talking about earlier?
Well, a couple of things. First of all, I think the antics about Elon Musk deciding when it's appropriate for him to come in front of the SEC and when it's not, that has actually proven to be more of a distraction than another 4 hours worth of a deposition. And quite frankly, this opinion never would have occurred had Elon Musk followed through with his entire team's plans to show up on September 15th, at which point they just decided to not show up. And so I think part of the challenge for Musk is just making sure that these are pretty simple rules of the road to play by. I know that he believes himself to be somewhat exceptional within them, but this is not going to be a very large issue, probably still won't be a very large issue. I think Tesla is the more interesting issue by a long shot. And it's not just a car company, remember. It's also a solar roof company, and it's also a battery company, and it's also a technology company. And there's a big question about where that next growth area is going to be. Part of the reason for the large compensation package, at least ostensibly, was to keep Mr. Musk on task and creative and putting all new growth opportunities inside Tesla. Is that going to change now depending on the outcome of this case? Does that bring about more possible litigation if Mr. Musk is perceived as funneling new ideas out of Tesla and into some of his other companies?
So, Craig, to Eric's point there, when you think of Musk and his leadership, obviously impossible to separate it from Tesla here, but even some Musk fans and some Tesla bulls really starting to get frustrated here. Do you see ever a position where Tesla would do better without having him as CEO?
No, I think Musk is essential. He's essential for the valuation. He's essential for the equity following of retail investors. And he's been the visionary. You talk to, senior executives out of Tesla, senior engineers out of Tesla, and they say Musk is absolutely impossible to please. He is unstoppable. He will not take no for an answer. And that's how he's getting these tremendous results, years faster than anyone else in the industry. He's a very demanding CEO and extremely intelligent about the way he looks at some of these fundamental problems that people just assume are unsolvable, or that the conventional solution is the right solution. Musk is Tesla. That is the challenge here over the next many years. How do you backfill him? I think if Musk was gone for Tesla, the valuation would change radically in a very short period of time.
I mean, do you see, though, an instance where if we did watch continued erosion of the market share, where we did see more perhaps erratic behavior from Musk in any of his endeavors that impacts the Tesla name for better or for worse, where the board would have to step in, or where investors, to Rochelle's point, might see a few more activist campaigns come about?
So, it's hard to point to something that an activist will want to bootstrap this to as far as a valuation, right? This thing is the outsized valuation of the automotive sector, valued at roughly the rest of the industry combined, right? So the activists I don't see in there. I do see share erosion. I do see others catching up. I do see many compelling EVs coming to market, even though this is going to be a very difficult year for electric vehicles. So the pressures are going to be on Tesla. But frankly, these price cuts that he's putting through, even again, $1,000 off the short range and long range Model 3 on Friday here in the US, that's going to create the market. These cars are going to be cheaper than the ICE alternatives. And yeah, it's painful, but these big automotive companies are going to have to follow or else lose. And EVs are inevitable. I mean, he's proven it at this point. So, it doesn't get easier. It gets more challenging, and there are very few executives that have actually shown well to this challenge. Musk is by far and above the leader.
We'll certainly continue to track all his decision making. Appreciate you joining us this morning. Craig Owen and Eric Talley, thank you both so much. All right, coming up, shares of Lowe's on the move after the stock got an upgrade from JP Morgan. We'll bring you the analysis behind the call after the break.
Time now for some trending tickers. We're watching shares of Lowe's after getting an upgrade from JP Morgan to overweight from neutral. The analyst behind the call also raising his price target on the stock from $210 to $265, saying the home improvement company will benefit from future Fed rate cuts. Here, there you're taking a look at the details that we just ran through here a moment ago. Shares certainly on the move off of this news. And one of the huge things that was called out, they also discussed the specific to the home improvement category. They estimate that they're less than 5% from pre-COVID wallet share right now with not direct to consumer, with DIY, that do-it-yourself, 75% of Lowe's mix, they note, versus 50% for Home Depot, experiencing a larger headwind since the start of post-COVID normalization in early 2021.
And I thought it was interesting, they drew the comparison with the DIY share of the business, which is much higher for Lowe's, 75% of Lowe's mix versus 50% for Home Depot. Right. And that they also, when in talking about the Fed's price cut, interest rate cuts, are saying, look, you have a lot of people who've been locked into these low price mortgages. And so perhaps if we see, interest rates come down, more people will be inclined to perhaps move, remodel. So it's really basing it on some of the confidence that they're seeing in that market and some of the hopes that some of that locked-in mortgage market will start to loosen a little bit there.
Yeah, as indicated, they also believe it's widely expected that Lowe's will guide somewhere in the 12 to 12 and 50 cents range, essentially, for 2024 to clear the decks here. So we'll see exactly what Lowe's has to come out and say this week.
Indeed, perhaps some good news for those potential homeowners. Also taking a look at Teva shares, also getting a boost in the pre-market as Piper Sandler upgrades the stock from neutral to overweight and raises their price target from $12 to $19. Now, the analyst behind the call citing growing contribution from the brand portfolios as one of the reasons behind the call. I did think it was interesting because we have seen a lot of these pharma stocks really have this question about what do you do next post-COVID? What is going to be the real driver here? And they talk about confidence in the pharmaceutical company, in their pharmaceutical company brand, and also the potential for further multiple recovery and expansion. So seeing some potential here, but it does seem to be a very stock-by-stock story when it comes to how some of these health stocks and pharma stocks are performing.
Yeah, absolutely. And I'm just taking a look at shares of Teva as, there we go, over the past year, still holding on to solid gains of about 22%. I think for the pharmaceutical industry at large, there has been more of this acquisitive mindset. M&A has been hot as of right now within this pharma landscape, as they're trying to make sure that some of the intellectual property that rolls off, that you're setting up for that next leg of growth. And so that's where we're seeing some of the M&A really be prompted and come forward, as well as just any focus around what are new landmark treatments and drugs. Landmark treatments during the course of the pandemic looked like anything that was on the messenger RNA platform. Now it's like, okay, but does it GLP-1? So there's just so many different ways to focus on what that next breakthrough in science will look like and how that gets passed through to some of the biopharma companies who are getting their leg of investment in early on ahead of time.
It's true, and also worth noting, because the Biden administration has been cracking down on some of these very expensive medicines, looking at the biosimilars, Teva seems to be better positioned in biosimilars and generics than some of its competitors here, so perhaps a little bit more of a competitive edge there for them as well. All right, coming up, we've got the opening bell on Wall Street next. Stay with us.
Let's take a look at today's stock to watch. We're watching shares of Teemo's parent company, Pinduoduo, after doubling down on another Super Bowl ad. Yahoo Finance's Madison Mills is on the floor of the New York Stock Exchange with more. Hey, Maddie.
Hey, Brad. So the tune of 4 ads for Teemo last night, leading to some positive action in the pre-market here. It's up over 1%. And as a reminder, as you mentioned, the parent company here is Pinduoduo. This is a Chinese-based e-commerce platform. And the big takeaway for me is that this is part of their $3 billion marketing budget just for this year, putting a lot of that money into the Super Bowl with those 4 ads last night. Are those ads going to lead to Teemo being able to take up some market share from, of course, the big competitor in the room, Amazon? And it was interesting to me that the tagline for the ad was "Shop like a billionaire," and it showcased someone buying all of these products, a lot of consumption there. The idea being that you can have it all when you're shopping on Teemo's platform because the prices are just so competitive. And even with Amazon really rewarding those sellers on the platform who are able to keep their prices as competitive as possible, Teemo is still beating them when it comes to the competitive pricing. And that is because of the Chinese manufacturing that keeps the costs down for producing those goods. It's just really hard for anyone to compete. Now, having said that, some negative news for the stock coming in the month of January. Morgan Stanley downgrading PDD, saying that they feel like it's kind of hit a crest, hit a tipping point when it comes to adoption of the platform. At my Super Bowl party last night, some folks had not heard of Teemo just yet. So my big question moving forward, is this marketing budget that they have going to allow Teemo to get that adoption for users in the United States? And is that going to allow them to continue to have a strong footing against the likes of Amazon? I also want to mention that this name did have a downgrade from Moody's in December, so there is still some question marks remaining for Pinduoduo here.
Yeah, a bold strategy indeed, especially as at the same kind of conversation point last night for myself. A lot of people asking, what is Teemo? So a lot of our friend groups might overlap, Maddie. We'll see. Ultimately, we got the opening bell coming forward here in just a few seconds. You're taking a live look at the New York Stock Exchange, and we've got the Nasdaq in Midtown, where IXIC is ringing the opening bell. Deutsche Bank ringing the opening bell at the New York Stock Exchange. Big symbol DB, celebrating Black History Month here. There you're taking a look at the bell ringers and some funfetti to start off this trading week as well, Rochelle.
Indeed, and we have team coverage of the biggest market movers following the opening bell on Wall Street. Yahoo Finance's Madison Mills is on the floor joining us again on the New York Stock Exchange floor, and Jared Blickery is on standby at the Yahoo Finance Interactive. So, Maddie, what are you seeing on the floor right now?
I mean, it's flat, right? We've got the S&P basically unchanged. It's dipping a little bit, but it was just flat there. Similarly with the Nasdaq and the Dow Jones. The Russell up 0.2% this morning. Listen, it's the Super Bowl hangover, right? You guys, it's very quiet here at the Stock Exchange. I imagine it's quiet at a lot of workplaces in the U.S. This is the record-breaking day for people calling in sick in the United States. So I'm wondering what's going to really drive this market today. And it's not just people not necessarily working hard. It's also a lack of momentum to trade on, right? We are kind of awaiting that CPI print tomorrow, and traders that I've spoken with this morning here at the Stock Exchange saying that there's just not a lot going on ahead of that. We obviously have a lot of earnings coming out this week still, but not enough to really move the market in today's morning trade. Now, having said that, I want to point out some earnings consensus moving forward. Yahoo Finance crunching the numbers on this, the graphics team looking into it and showing us that there's a lot of positive consensus heading into the rest of the year when it comes to the earnings print. It looks like the end of 2024 is going to see the biggest jump when it comes to beats on earnings. So it looks like we're still pricing in a positive year ahead, guys.
Indeed, of course, still in the thick of earnings season. Appreciate you for joining us, Maddie, there. Well, Jared Blickery also at home base here at the Interactive. So, Jared, what are you watching?
Well, I'm watching the majors under a little bit of water here, but the Russell 2000 has caught my eye. And let me just chart that real quickly. Up 0.8% in the early action. This is a 3-month chart, and I showed this on Friday morning, how it was on the precipice of breaking out. Well, guess what? It did so Friday, and it's on its way today, probably racing toward these highs, which, by the way, are not record highs. You can see on this 3-year chart, you'd have to go back to 2021, and they're somewhere up here. But let me just get to the S&P 500, some interesting comments coming out recently. In the light of all this strength that we've been seeing, especially over the last 3 months, you can measure it from the October 27th lows. But the bottom line is there's a lot of strength in this market. And as it usually goes, strength tends to beget more strength, except sometimes in the short term. So let me just show you what Steve Depp is taking a look at here, saying today's market, and this is Friday, just the 6th time in the history of the S&P 500 that the index finished a calendar week with a trailing 15-week return greater than 20% and at a new all-time closing weekly high. And ironically, we're in the same exact position exactly 3 years ago. I just want to mention 6 times in history. Guess what? I know these numbers are small, but 3 of these have happened since the pandemic, including the current time. And then besides that, you'd have to go back to the 1980s. I want to move on to the sector action for today. We were seeing healthcare and discretionary and as well as tech leading last week. But today it's energy. Energy in the forefront with materials and real estate. To the downside, we got tech, healthcare, and utilities, guys.
All right, Jared Blickery, thanks so much for teeing up the session here for us and the rest of today's trading activity with what to keep on your radar, everyone. Stocks trading, well, lower right now, just after the opening bell. Mixed, as the Nasdaq says, hold my beer here, flat, just barely to the upside. The Dow and the S&P 500, though, in the red. This comes after a historic milestone. At the end of Friday's trading session, the S&P 500 closing above 5,000 for the first time ever. Optimism as well around tomorrow's CPI print might keep market momentum strong. For more on this, we've got Ben Emmons, who is the New Edge Wealth Portfolio Manager. Great to have you here in studio with us, as always, Ben. One of the huge things that we've been tracking within this market is just trying to figure out whether or not this momentum can continue at this juncture and what it would take.
Yeah, the CPI will be a catalyst for that momentum because everybody's looking at these rate cuts, and we've taken back some of those. You know, we're about 7 priced in, we're about now a little bit more 4. There's a lot of expectation that the Fed can move, but they are in a rush. Yet we're reaching record highs, so I think the rate cut needs to stay alive in order for that momentum to keep going. So it's interesting to see these small caps today outperforming for the first time. A lot of people talk about rotation, that it wasn't happening this year. And yes, the Russell has lagged the Max 7 and the tech index quite significantly. So the CPI could be a catalyst for that change, perhaps, because if CPI continues to moderate, economic growth will be really supportive. And that, I think, will boost the rotation to the small caps.
So do you think this takes recession fears off the table, especially when you look at the performance right now?
I think they're completely off the table already like several months now. I would even make the case that the econ bear, so to speak, has just been plainly wrong for more than a year, because what we're really dealing with is an inflation rate that was, excessive, but the fact that enough tightening put in the system to get inflation nicely, gently down. We're getting a little bit help from China too, by the way, that are in deflation for now. And so recession would have only happened if we're getting a major collapse in prices. That doesn't seem to be going on. So this is the soft landing, if you will, or the no landing. And hence, I think the breathing room for small caps here. Yeah.
Then Federal Reserve Chair Jerome Powell is expected to keep rates steady in March. Earlier today, I actually had the opportunity to catch up with Steve Pagliuca, Bain Capital Senior Advisor. Here's what he had to say about the central bank's path towards potential rate cuts this year, and then we'll get your reaction on the other side.
There's some over-exuberance around cuts, and people have seen lower interest rates. But again, I think if they look at history, that's an anomaly.
And so with that in mind here, the market's anticipation that the Fed will cut and that we're pricing this in way too early, perhaps, versus the higher for longer for an extended period of time, more so than we thought was possible. I mean, what does that even do to the portfolio positioning that people should be considering at this juncture?
Yeah, it's the economy, and I think it is still speaking to that cash, as we talked the last time, in the trash. Yeah. You could put it somewhat in the trash, but maybe not entirely. Secondly, higher for longer rates does mean a stronger economy. It would, otherwise we would not have those higher rates. We would really go back to where we came from pre-pandemic, of a sluggish economy. I don't know what will happen as of January 2025 with the new president in the White House and how all policy is going to change and what the economy is going to do. But I think this year will be much about, yes, you could expect this Fed to stay somewhat higher for longer, really because of better economy. Otherwise, I think the Fed will be moving much quicker to rate cuts. Can they cut rates? They can, but in their thinking it's about the rate is here and the inflation rate is to continue to decline. There's some room. But by calculations, that room is not much. I think last week was an important signal from the Fed, several of them, that they're not looking at 3 cuts, but perhaps more like 2. I think that's what's in the market's mind now.
And so, Ben, when you look at what helped us get to this point with the S&P 500, looking at the Mag 7 here, when you have so much of it concentrated on these stocks, we're starting to see a little bit of the broadening out here. But how much is now going to depend on that broadening out?
Yeah, how Mag 7 will actually moderate from here, really, right? Because it is really unbelievable what's happening. I mean, during the Super Bowl, they had the ads for the Copilot from Microsoft Office, and I immediately plugged that in. I thought, hey, this is fantastic, right? And I think this is that momentum in these stocks is about the investments are made in AI. There's a huge amount of capital expenditure going on or planned, and that's really driving the momentum of those stocks. So is that narrative going to change? Are people going to say, okay, that's all now in the price, let's look at value elsewhere? And I think this is the bit of the juncture in currently. So it's not only about rate cuts, it's also about the story of how AI develops itself over this year. It's a phenomenal story, but it should at some point kind of be priced in and taken back.
All right, since you mentioned the Super Bowl and Vegas, we got to talk about what you'd mentioned to us earlier and sent to us in your notes. Swift in Vegas stays in Vegas was the title of it. And you've got the Swifties stock basket, if you will. Who are they?
Yeah, it's amazing that people have looked at IMAX and AMC or AT&T and Spotify are companies that are directly linked to the business dealings of Taylor Swift. It has to do with her concert rights and that type of thing. That basket is on fire, right? And it literally is taking off like a rocket. If you plot a GDP now against that, you see the same trend. So I've been a bit of the view of that Taylor Swift, great music, but she has an economic impact. It's been recognized even within the Fed to an extent. If you think what happened yesterday, 300,000 people flocking into Vegas and everything that happened there, I would think that some of this will have an impact on GDP. So there's estimates out on that. It could be in the billions of dollars. It's not insignificant. So the Swifties are there. The idea of that she's having an impact also on people's choices, right? That people look at her clothes, not at the jersey of her boyfriend. These are, I think, real things.
Yeah, well, his jersey sales spiked too, so he's a secondary beneficiary, I suppose. But at the end of this has been amazing to watch, and of course, the conclusion of the NFL season yesterday. Ben, thanks so much for taking the time here on the day. As we were saying off camera, Swift and Usher, they won the Super Bowl.
Indeed.
Ben Emmons, thanks so much for taking the time. And for more on the Fed policy playbook, we're going to hear from Steve Pagliuca, who is the Bain Capital Private Equity Senior Advisor and co-owner of the Boston Celtics. That's coming your way, 10:40 a.m. Eastern today. You don't want to miss it. Coming up, could ARM be the real winner of the AI race, or is Nvidia still king? Our expert panel weighs in on this next.
ARM opens the day higher, up over 9% today and 70% from a week ago. Now, this pop in the stock has sent the chip designer's valuation soaring, now valued over 90 times forward earnings, surpassing AI darlings Nvidia and AMD. But is ARM actually worth the hype? Well, joining us now are Charles Shi, Needham & Company Managing Director and Senior Analyst, and Bob O'Donnell, Technalysis Research President and Chief Analyst. A big welcome to you both. So, Charles, I want to start with you. In terms of this valuation, what is the base case for it having this valuation that's blowing past a leader like Nvidia?
Well, I think there's a lot of expectation about the ARM being an AI beneficiary. I mean, specifically generative AI trend that has been driving Nvidia higher and higher this year, right? But we have been having this view that ARM, their exposure to generative AI, despite all the talks, remains quite small. And it remains to be seen whether they can actually benefit from generative AI going into the future. It has been the trend over the past year that a company with a tiny little bit of a generative AI exposure can treat it as an AI story, and the stock went higher. And well, the valuation definitely is a head scratcher to us.
And so, Bob, I want to bring you in here as well. I mean, ultimately, ARM has been a punch of the fanfare, at least the new kid on the block, while NVIDIA has been, of course, that decades old now at this point story that's continued to grow up and get to that $1 trillion market cap valuation quicker than we've seen of any company at this point. So what is it going to take in terms of both of these companies securitizing their own market share at the same time looking at an industry where there's plenty of demand that's come forward?
Well, I mean, here's the thing, Brad. I think ARM has been the most unappreciated company in tech for a very long time. I mean, think about it. Apple, Samsung, Amazon, Google, everybody you can think of in tech, Nvidia, of course, as well, uses their technology. And they've just been there in the background for such a long time. And now, of course, are getting this association with AI. And it's true. I mean, right now, they are not doing a ton directly in AI. There's a lot of opportunity down the road. But remember, their people license their technology. They're creating the cores of a lot of these chips. Remember, NVIDIA wanted to buy ARM because they knew how critical the technology was, and people in the tech industry kind of revolted and said, no, we don't want that to happen. But now the entire market, I think, is starting to recognize that. So to me, a lot of this is a reflection of people finally kind of understanding ARM, what they do, what they're capable of. And yes, I think down the road, you will see them be able to drive generative AI. And they're in automotive, they're in so many other places as well that people, haven't really thought about before.
And so, Charles, to bring you in here then, what sort of moat do they have then when you think of the competition in this space?
Well, the thing about the moat really is they are very strong in mobile, right? No doubt about it. They're dominant. There's almost no competition on mobile for them. Data center, that's what they think. There can be some tailwind behind them. But the thing is, there's Intel, there's AMD, there's x86 as the more incumbent has been established. All the software ecosystem built around them. And then you got a RISC-V, the new competing instruction set architecture competing from them as a free open source. So I think it's not as straightforward to say ARM has a wide moat and they're definitely going to win the future. I think they will have their place. But expectation, once again, I think is very, very high at this point.
Does the revenue model, Charles, that they've shifted to, does it really account for what's the reality of where and which devices those chips will be embedded to in the future?
Yeah, again, as I said, it has been really a head scratcher for us. Institutional investors I spoke with, definitely nobody will confuse ARM as the one who is being benefiting in any big way from generative AI, from data center. Maybe they continue to do well in mobile. They need to raise the royalty rate in order to better monetize what they already have. But for things they don't have right now, data center, they probably have 5 to 10% of the market share. To get to that as the same dominance as in mobile, it's a very long way. Maybe you think that's an upside, but the market share looks like this for a reason. Intel, AMD, x86 still very strong.
And Bob, of course, a lot of people, talking about generative AI in these earnings calls, but we are starting to get into that show and prove phase. How much upside do you see here for ARM versus some of the competitors who have perhaps some more concrete examples of how this is actually going to play into their broader ecosystem?
Well, I mean, again, on the ARM side, I mean, Charles is right. Their market share is relatively modest. And so it's, going to take a while for them to get where they need to go. But they are at the heart of a lot of these devices in the data center, obviously in mobile. We're starting to see generative AI being run on devices, on smartphones. We're starting to see it on PCs. ARM is going to have a play in the PC world via Qualcomm later this year. So there's a whole bunch of places where ARM is going to be touching the generative AI market. Also, their designs are at the heart of a lot of the accelerators. So you see ARM being leveraged in Nvidia products. I mean, Grace Hopper is a product from Nvidia that has an ARM CPU and an Nvidia GPU. So you've got these things combined. So I think people are looking at some of the opportunities there, perhaps giving them a bit more credit on the generative AI side than they deserve at this point. But if they're thinking longer term, the opportunity is there because, ARM has also adjusted its business model to not only license the actual chip IP, but also other elements around it. So they're getting a bigger piece of the pie on every single device that their technology is being used for.
Charles Shih and Bob O'Donnell, thank you both. Appreciate it.
Thank you.
Thanks. We've got all your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, artificial intelligence remains the talk of the town in 2024 after the boom in 23. As more companies expand AI investments, Wall Street is weighing in on who stands to benefit from the AI liftoff. Jefferies shouting out Meta and Alphabet as best positioned to win the consumer AI opportunity, while Evercore ISI names Apple as an underappreciated artificial intelligence beneficiary here. Just a larger question of what artificial intelligence and generative AI consumers will flock into, and who within not just the software space, but also the hardware space, where it's extremely difficult to get that right out of the gate, where the early adopters will perhaps have a thought process or at least some type of praise that permeates even further into the common consumer that's out there as well.
It's true, because when you think of perhaps adding generative AI on as something to add on that you don't already have, versus the note that we saw from Evercore ISI analyst Amit Daryani saying that the company is an underappreciated AI beneficiary, but then really ties it to Siri. So something that you have, millions of people who already have these phones in their pockets already use Siri. So really a natural evolution there versus having to add ChatGPT onto something else that you're perhaps not familiar with.
Right. They said that, and in this Jefferies note, it was interesting. 89% of full-time office workers in the U.S. have heard of ChatGPT. That's up from 52% in February of 2023. Now, the increased usage of AI tools, they're also mentioning there that in tandem, it kind of brings fear of AI job automation. What we've had a discussion about time and time again, whenever there is a jobs day, and we're talking about when AI is going to show up in the productivity numbers, when generative AI is going to show up as a broader impact to the employment situation. I mean, we're still ways off from it having a huge impact on either of those fronts, but it is a larger question of how many corporations are already starting to plan out what resources look like, what spends on technology versus human resources also looks like to facilitate and unlock perhaps that next leg of productivity, and how many of us are working in tandem with some of that generative AI to complete menial tasks at the end of the day too.
It's true, because even though clearly a lot more people have heard of it in terms of how they use it in their work, I think a lot of people are still trying to figure that out, because it's one thing to have it there sitting there, and then you're really not sure if it's something that you can use, if you have permission to use it, how much of it you can use, the sort of the ethics around it. So I think perhaps if there was a bit more clarity in how people could use it, and even how useful they find it, because usually it's creatives, or it's for some of these menial tasks. But if it's like mid-journey, something else, something creative. But then when it comes to your everyday working life, where those guidelines fall, still not clear.
I mean, I think in marketing automation tools is one area easily it could have a big impact. You think about all the different marketing automation campaigns, and I'm thinking of how this could impact a company in Oracle even, and some of the subsidiaries that they have, or even in Salesforce, where, and as they had their AI day last year, and we're talking about how it can help sales teams more efficiently craft an email that could be ready to go out. So what type of jobs does that impact? How much quicker does it allow you to have that touch point and bring back in different points of contact that you've had with a customer? So there's a bevy of different ways to think about how it could be implemented.
Indeed, still figuring all of that out, of course. Well, we still have all your markets action just ahead, so stay tuned. You're watching Yahoo Finance.
I'm Brad Smith alongside Rochelle Akufo. We're about 30 minutes into the trading day. Let's take a look at how things are shaping up right now. Stocks taking a breather this morning, flat after the S&P 500 closed above 5,000 for the first time ever. Investors also awaiting key inflation data that's coming Tuesday.
That's right. And also taking a look at some individual trending tickers. Shares of task management software company Monday.com sinking today as its revenue outlook comes just in line with analyst expectations. Not enough to impress investors, though. The company did beat estimates on its top and bottom line in its fourth quarter, driven by a boost in prices.
And Rivian stock falling after getting a downgrade from Barclays, driven by weakening demand in the electric vehicle market. The analyst praising Rivian's vehicles, but warned that EV pressure in sales could lead to weaker pricing and bigger losses for a company like Rivian that still needs to raise capital.
And Joby shares climbing higher today after announcing its air taxi service could be coming to Dubai by early 2026. And the company signing an agreement with Dubai's government, giving them exclusive rights to operate air taxis in Dubai for 6 years.
A recent poll shows 21% of economists are starting to consider current monetary policy, quote, too restrictive. That's the most in over a decade, according to the National Association for Business Economics. This comes ahead of the January read on inflation, which the Fed is watching to help guide the path for rate cuts. Here to discuss this and more, we've got Thomas Phillipson, who is the White House Council of Economic Advisors, former acting chairman during the Trump administration. And thanks for taking the time here with us today. So, from your estimation, even if this print comes out still in trend with what we've seen of inflation over the past couple readings here, what does that trigger the Fed to do, if anything?
Yeah, I think everyone is expecting sort of no change relative to last month in the month-to-month numbers. But since that's replacing a bigger number in the past, the year-to-year is going to fall quite a bit. It's sort of the expectation. I think the future of CPI is so driven by housing, as you know, is 40% of the core. And housing has responded kind of strangely to the rate hikes. So the rate hikes are supposed to dampen demand in credit-sensitive industries, housing being the primary one. But what has happened is that supply has gone down because people are sitting on their houses. They don't want to switch mortgages from COVID sort of low-rate mortgages. So prices in the housing obviously has gone up with these rate hikes. It's kind of counter to what we want them to do. It's been price inflation for 40% of the core due to the rate hikes. So I think how that's going to trickle down the next year is going to be very, very important for both how the CPI reacts, but also as a consequence how the Fed reacts.
And to that point, Thomas, how are you expecting the Fed to react? What do they need to see to really sort of dig their heels in and believe that they have inflation under control?
Well, I mean, I've been arguing a long time that they have the wrong framework. It's not just me. A lot of people have argued, this Phillips curve framework where they have to kill the economy to kill inflation. A lot of economists don't believe in that framework, even though it is the sort of book, instruction manual in DC in some sense. If you just take the 2 last years, in 22 we had very slow growth, we had rapid inflation. In 23 we had pretty strong growth, but inflation coming down. That's just an example of this Phillips curve relationship where inflation is not driven, or you don't have to kill the economy to kill inflation. Essentially, I think most economists think that this enormous monetization of the debt with a 40% money supply is the cause of this inflation, and it's going to wind off over time, essentially. But the Fed will react in a very predictable way, given that they have this, in my view, inaccurate framework that they're based on.
So do you believe that the Fed is going to be able to adequately stave off a recession, perhaps even any of the hard landing talk? And ultimately, what does that mean? Are we I mean, I hate to continue, as many of us, using this airplane analogy of a soft landing or a no landing. What does the reality look like, and is that becoming more clear from your perspective?
Well, I think their framework is the wrong one. So if they're lucky, it's kind of if we have a soft landing, it's not due to them engineering it. Certainly, they're the one who caused it. Everyone believes that the monetization of the debt is the cause of the inflation, essentially. And the question is, can they, with this, in my view, inaccurate framework, be lucky enough to have a landing that takes place in a way that doesn't damage the economy. I think people are concerned, myself, that this growth is so leveraged, both on the public sector level. Obviously, we have a deficit that's the highest in a non-crisis economy, meaning outside COVID crisis and the financial crisis and wars, this is the deficits we've never seen in a successful economy. But also on the private side, people are taking out 1.3 trillion in credit card debt, et cetera. So it's a very leveraged growth, and that's what's worrying a lot of people, I think.
And Thomas, I want to ask you about some of the criticism of the Fed. I mean, we talked about the NABE poll. Economists haven't been this critical of the Fed being too tight since 2010. And of course, there's political pressure. How much does the Fed actually pay attention to this noise?
Well, they have, like I said, they have their framework. They try to stay independent, both of the market noise and the political pressure, obviously, that's enormous on them to cut rates in an election year. And I think they're pretty good at staying away from that kind of a disturbance, essentially. But I mean, what they have done, I mean, where in the economy we've seen most inflation is where they have intervened, right? So if you think of it, the sector of the economy where we've seen most inflation is in the price of credit. If you're a mortgage payer, basically, and you go from 3 to 6%, that's 100% increase in your monthly payment for your mortgage. That's much more than gas, food, et cetera, that we usually talk about. And if you're a credit card holder, it's gone from 14 to 21%. So that's a 50% increase in your price of credit. God forbid you're a bank and you went from 0.5 federal funds rate to 5% federal funds rate. That's 1,000% increase in your price of credit as a bank. So I think people need to understand that, we're trying to fight goods inflation with enormous inflation in the price of credit, and that obviously has havocs in the economy, and that's why people want it to ease up.
How can the Fed ensure that there's not a spike in inflation on the other side once they do take their foot off of the gas here? Perhaps not on hiking further, but on the other side of that, not cutting too soon and then seeing a ton of demand, and especially in an environment where we've already been remarking on the resiliency of the consumer, that prices don't spike once again.
Yeah, I think it's more of a fiscal issue. I think when the House came in and turned Republican, that put some restraint on the massive amount of spending we saw. I mean, it didn't completely eliminate it, but it certainly put a downward pressure on it. And I think that's the most important force here in terms of dampening a resurgence of inflation.
Thomas, thanks so much for taking the time here today. Thomas Phillipson joining us to talk all things the economy and, of course, what the Fed's going to do with their next decision. We'll see what the data does in terms of moving the markets and the Fed. Thanks so much, Thomas.
Thank you.
A slew of earnings are out this week. We have you covered on what to watch for when Airbnb reports results tomorrow.
Airbnb, a company that's become synonymous with travel and leisure. Airbnb is now a verb in its own. The last time the booking platform reported a solid performance, it was overshadowed by a less than rosy outlook for the fourth quarter. So, what should you look out for this quarter? Here are 3 things you need to watch. Number 1, booking growth. Looking out for 2 key metrics. First, gross booking value. That's the total amount of payments processed on the platform, everything from host payments to cleaning fees, but it does not include cancellations. Last quarter, gross booking value landed at over $18 billion, a 17% gain from the prior year. Then there's nights and experiences booked. The platform reported over 100 million bookings for the quarter, which topped Wall Street estimates. Now, as we turn to the fourth quarter, the revenue figure will be closely watched as the company guided a little below expectations. Number 2, international expansion. In the last quarter, Airbnb said their expansion plans into international markets is gaining momentum. Keep an eye out on what is called underpenetrated markets. That means a market with little competition for the same service. Asia Pacific is one, but also take into account markets like Germany, Brazil, and Korea. Beyond that, it's important to have a pulse on anything the company has to say about AI and how it could be a game changer for international growth in the coming months. Lastly is regulation, another key area to watch. In the third quarter, Airbnb slightly saw higher prices for short-term rentals, but this area could be hurt by changes in the regulatory landscape. For example, New York City's new law requires all short-term rental hosts to register with the city. They must show when their guests are staying, and only 2 guests can stay at a time. This applies to all other platforms like Vrbo and Booking.com. The big question here, will other cities follow suit? And what could it mean in the long term? There's a lot to digest as we look at Airbnb's fourth quarter earnings, and Yahoo Finance will be tackling the latest developments.
Broke the internet again.
Verizon didn't break.
You ain't gonna break me.
Still works.
Okay, they ready. Drop the new music.
Beyonce certainly knows how to make a statement. Queen Bey teaming up with Verizon in the latest Super Bowl commercial to promote her new music. Millions tuned in last night to watch the big game where the Kansas City Chiefs became the first team to win back-to-back Super Bowl championships in nearly 2 decades. The Chiefs pulling off an astounding second-half comeback, beating the San Francisco 49ers with a final score of 25-22 in overtime. But of course, when we weren't watching the high-stakes game, we were able to kick back, relax with some entertaining advertisements. Brands that you know and love shelled out millions of dollars to have their commercials featured last night. But which ones were a hit? Let's bring in Jason Harris, Mechanism co-founder and CEO, and Marcus Collins, University of Michigan's Ross School of Business marketing professor, to discuss. Gents, great to be able to take some airtime and really break down what we just saw. What did we just watch? And Jason, I'll begin with you because you're here in studio with us, and we were talking a little bit beforehand here just about the atmosphere that you had going on at your place, where you're telling everybody, shut up, I need to watch this ad at home.
Yeah, I have a Super Bowl party every year.
Yeah.
Everyone's eating guac and chips and talking in between the game, and I have to be like, I got to take notes.
What was the clear strategy then that emerged in these commercials from your purview?
I mean, I think the playbook that is pretty developed now is you keep it simple. You get a celebrity, you get humor, and then you have to get the brand in there, so it doesn't become just a celebrity ad. You got to really sell and get the brand in there. But I thought what was interesting this year is it felt like a lot of ads were kind of celebrity vomit. They had not a celebrity, they had let's cram 5 or 6 celebrities into the ad, and I think that made the message harder to get through for the brands.
That's an interesting point there, because we've got that Uber Eats commercial playing, so the same thing with the Dunkin' Donuts commercial. Marcus, what did you think was the recipe for a really successful outcome, and really how companies can build on this once they have the buzz going?
I think it's actually becoming increasingly difficult. One, because our expectations of Super Bowl ads are kind of through the roof. It's almost like New Year's Eve. It's never going to actually live up to your expectation. That's the first. The second is that today, we're in such a divisive time post Bud Light's debacle last summer that brands are much more cautious about what they say, what they do, especially on a stage like the Super Bowl, and therefore they don't take very many risks. So while the ads were fine, they were good, they were well served, they weren't superb. I think a lot of it had to do with that we have constrained the creative brief, that they cannot play in a lot of spaces. It's a lot more confined, and therefore you get what you get. You don't get upset like we tell our 4-year-old.
Sure, and at the end of the day, it comes down to return on investment, right, Marcus? So we have. It remains to be seen who is going to get that best return on investment, but at least kind of in fanfare and how people are talking about it the next day, you can get a little bit of an informal gauge there. Who, from your perspective, though, did win the Super Bowl ad deluge of messaging that we saw?
My take, I think, probably State Farm. State Farm's ad was well contextualized, good, set up to a joke, good premise, but also good play with Arnold Schwarzenegger and Danny DeVito. And it landed, to Jason's point, it landed the brand's point of view that we're here to serve. We're good neighbors. Now, you cannot sleep on Verizon. While you may have whatever you have about the ad, the fact that Beyonce was able to coordinate a new song, release 2 new songs, and the teaser for the album that's coming in March. This is going to be a country album from Beyonce, Renaissance 2. You got to give Verizon some props on that one for sure.
And it really does then, as you said there, raise the bar for what people are expecting from these Super Bowl ads. Are there any that you felt fell flat?
Yeah, I think when the T-Mobile ad, when they try to cram, I don't know, there's Laura Dern, the guy from Suits, Bradley Cooper, just random celebrities, almost like whatever celebrity they could get their hands on, they put into an ad. And I think the brand gets lost. And I think, as Marcus said, State Farm was Arnold Schwarzenegger, and the joke was their tagline. So that really resonated and it stood out. The other one I really liked was Sarah V with Michael Cera, because
thank you.
You like that one?
It was an unpopular decision, apparently, for me to say that one was one of my favorite ones to our newsroom. But hey, guys, I won.
Yeah, but I don't know if Marcus agrees. But for a brand that doesn't have it's not a famous brand. Maybe you're not even sure how to pronounce it. I think it did the job because Michael Cera, Sarah V. It's very clear. What the brand is, and you remember it. It's sticky. And one celebrity, one joke, playing off the name, it landed. While it might not be the riskiest ad ever, of course, like Marcus said, it does the job, and it's worth the $7 million to pay for media because now this brand is well known and you've heard of it. So I think it did the job.
Indeed. So then in terms of what are the benefits then, I want to bring you back in here, Marcus, for some of these Super Bowl ads that ran before the big show, what do they get out of it that, say, the ones who just spent that average of $7 million for a 30-second ad spent for during the actual game?
They get us. They get more media. We talk about it for longer, right? It's not just 30 seconds anymore. They got a couple of weeks exposure. They get more time. And then we talk about it after the fact. So what it does is it helps amortize that $7 million 30-second spot. And if they're lucky, maybe their spot actually runs twice during the Super Bowl because there's overtime, right? I don't know about you all, but I think I saw the Teemo ad maybe 5 times. Like I was like, good grief. And it didn't deserve to be on Super Bowl, but that's another story for another day. But the point is that we try to put things early in the upfront so that we can get more bang out of our buck, more media out of our buck, which is essentially what people are spending the money on the Super Bowl. Biggest media moment in the country. They just want media.
So what's the setup now? And I'll put this to both of you. I mean, we're staring down a calendar right now where you've got just finishing the Super Bowl. We've also got, of course, just weeks away, actually next week, NBA All-Star. We've also got March Madness relatively soon after that. So you've got multiple weeks and now months of straight ad blitzes that are going to be taking place. What does this set up for marketers? What does this mean for ad spends? And ultimately, how this is tracking through to a consumer, because this is a demand generation environment where we've heard time and time again from retail CEOs that consumers are being more value conscious and value hacking as well. Marcus, I'll go to you, and then I'll bring you in here, Jason.
Yeah, I mean, this is the power of culture. We identify cultural moments where the brand can have a point of view on that particular contextual moment within a certain frame such that the brand can say something meaningful, whether it's the Super Bowl, whether it's Oscars, whether it's Grammys just a week ago, or All-Star Weekend. These are all just opportunities for the brand to be more than just a toothbrush, more than just toothpaste, but actually have some significance in the cultural zeitgeist. And we use these moments as vehicles to communicate the brand and the way it sees the world so that we can connect with people in really sticky ways.
And I think these are the moments, because it's live sports that we're talking about, where you're actually watching the ads. You know, you're not skipping the ads. It's not a streaming platform. You're watching the ads. That's more valuable. That's going to cost more money. And you're riding the wave of the pop culture zeitgeist of the moment. So those are just going to keep going up in cost.
And speaking of the zeitgeist, obviously you couldn't throw a stone without hitting AI, even before generative AI, even before the Super Bowl. But then to see Microsoft Copilot, something that still a lot of people not really that familiar with how it works. What do you think about AI being, you know, the dominant theme here versus, say, what we saw with crypto a few years ago?
Yeah, I actually thought there was going to be a lot more AI in the Super Bowl. You know, I think there was like 1 or 2, but I thought Microsoft, you know, they have a real good head start, and I thought they did a great job with it. What do you think, Marcus?
Oh, absolutely. I mean, I think the difference between AI and crypto is that last year, crypto was trying to convince us that it's legitimate, that, hey, this is worth talking about, is worth investing yourself into. With AI, we're already using it, whether it's AI through chatbots. We find ourselves more engaged in a generative AI space. And ultimately, what we're trying to do is figure out how we implement it. But it's in our world. There is no getting away from it. So it didn't require a ton of convincing. This wasn't about legitimation. This is really just about context.
I think that is an important distinction there that you brought in. Appreciate you both for joining us. Jason Harris, Mechanism co-founder and CEO, and Marcus Collins, University of Michigan's Ross School of Business Marketing professor. Thank you to you both.
Thank you much.
All right, we still have all your markets action just ahead. Stay tuned. You're watching Yahoo Finance.
Some of the biggest consumer staples companies like Kellanova, Molson Coors, Coca-Cola, they're releasing earnings this week. After the sector declined 3% in 2023, is recovery on the horizon? Here to tell us more, we've got Brian Spillane, who is the Bank of America Managing Director of Equity Research. Great to have you here with us this morning. What is the common denominator that we should be expecting going into these reports and the reality of what you believe these companies might say?
Hey, yeah, thanks. Good morning. So, I think this week, which is closer to the tail end of earnings season for the group, a couple of things we're watching for. One is volume growth, organic sales. It's been a real key theme across the whole space through this earnings season, just the revenue deceleration and whether companies can grow volumes off of, after several years of raising prices to keep up with inflation. We think that Coke sets up pretty well tomorrow. We do expect to see a decent volume growth as they exit 23 and into 24. Molson Coors also, which is reporting earnings tomorrow, will also be interesting because they've gained market share. And they've really taken advantage of Bud Light over the last 9 months. And we expect to see them have actually a pretty strong revenue print tomorrow as well.
So Brian, of course, Coca-Cola, a Warren Buffett, Berkshire Hathaway favorite there. In terms of what you're expecting, especially impact of GLP-1s, we know that keeps coming up in conversations. Still waiting to see that, though, coming up in the bottom lines here. What are your expectations there?
So GLP-1, we sort of look at it as almost like putting climate change in the 10K, right? It is a horizon risk. How many people will actually be on these drugs? Will they stay on these drugs? What will their consumption patterns be? A lot of that is still unknown. So, there's zero impact on current results. We don't have anything built in our models right now. As we've taken a longer term view and based on the projections that our healthcare analysts have in terms of potential user base over the next 5 years, it's like a 2 to 3% impact on calorie consumption. But again, it's a lot of headline, but not a lot of impact, at least in terms of the way we see it right now.
What is the read through that we could gather from the consumer from these reports as we're thinking about a consumer that has been more value conscious and, as we were discussing earlier, is looking for value hacks? What is that consumer resiliency story as it pertains to consumer staples that we could hear from this week?
Yeah, it's a great question. So a couple of things that you might want to look for. One is consumers spending more time away from home, right? Pepsi reported on Friday, and one of the things they talked about was they're seeing an even more normalization of consumer mobility. So people still traveling, eating out more often, back to the office, and it's caused a real channel shift, which looks more like 2019 in terms of the amount that's consumed away from home versus at home. So especially as we look at Coke and Molson Coors, two companies that have pretty large away from home or on-premise businesses, to the extent that consumer is out and about, if you will, and spending, that'll be one sort of indicator of health of the consumer. I think the other, in terms of consumer health and I guess choices they're making, a lot of this is acclimating to price points, right? And what we perceive as a value today versus maybe what we did a few years ago. And for instance, with Coke, is it a 12-pack at $7.99 today, where maybe $5.99 was the value price point before? So really trying to hear not so much the demand, but just are consumers beginning to find value at certain price points when products are promoted.
It's true, because you are starting to hear consumers wondering why, if, especially in the news, they're hearing about inflation starting to come down, prices starting to moderate. They're still not seeing it in some of their tried and true favorite snacks and drinks here. At what point do you think the consumer starts to pull back more significantly?
Yeah, so I don't think the consumer is actually going to end up seeing lower prices across these branded goods. You've had, again, a material step up, 20 to 30% increase in costs over the last few years. The pricing is really just to protect margins. And these are brands, right? They're not commodities. They don't pass through inflation or deflation as the cycles move. I mean, that happens in products like sugar or coffee. So my expectation is these companies are going to hang on to the pricing, hang on to the margin, and then now reinvest back behind the brands to drive consumers, back into those brands. But basically, if it's a standoff, right? The consumers are standing off with, or I'm sorry, the companies are standing off with the consumers, getting them to sort of see value today at price points that, they weren't seeing a few years ago.
We started off the segment talking about the year that was in 2023. We saw, of course, if you're tracking up against XLP, that decline over the course of the year. Is this the year, 2024, one where we're expecting a comeback, a pivot or a rebound, rather, within consumer staples?
Yeah, no. I mean, we came into this year, our theme was, kind of running in place, right? And as you noted last year, we had positive earnings revisions through most of the first half of the year, yet the stocks were down, right? So we had multiple compression. But frankly, being in the part of the cycle we're in, right? It's a risk on tape. It's, soft landing or whatever the positive adjective is. These stocks are late cycle stocks, right? So we do think that they're valued correctly for where we are in the cycle, but we expect, relative underperformance relative to the market as long as we continue to be in this risk on tape.
And so, Brian, do you think for people who have had perhaps cash sitting on the sidelines, looking at some of these more beaten up sectors, is now the time to jump in?
So our experience and a lot of the discussions we've had with investors over the course of this year, it's a little bit more selective. So rather than just buying the group, what we are seeing is when high quality stocks or companies stumble, right, there's a willingness to buy that quality. So, we saw that with Hershey last week. We saw it with Procter & Gamble 2 weeks ago. It'll be interesting to see what happens with Pepsi because their revenue guidance was a little bit below where the street was. But I feel like what we're seeing from investors, not necessarily increasing their weighting in consumer staples, but when they see some of these high quality stocks on sale, we're seeing portfolio managers add.
With that in mind, Brian, your top pick for this sector for this year?
Yeah, sure. So as we move through our consumer staples coverage universe, we like Colgate and the household and personal care companies. Revenue acceleration, earnings acceleration. We see that we think there's positive earnings revision potential. Within beverages right now, we're actually Coke over Pepsi, and again, it gets back into this. We think Coke has a year where they'll have sort of a higher quality top line, both in terms of balance between volume and price mix. Within packaged foods, our team likes Lamb Weston, which is a frozen potato manufacturer. We see both revenue and earnings upside, especially as they move the back half of the year. And among the center store packaged food companies, we still like Kraft Heinz, sort of best in class in what is, somewhat of a challenged block.
All right, we got some tickers for our viewers, of course, to check out on that Yahoo Finance platform here. Brian, thanks so much for taking the time here today. Brian Spillane, Bank of America, Managing Director of Equity Research. Thank you.
All right, you're welcome. Thank you.
Well, it's everyone's favorite time of the year, tax season. Here's what you can expect this year.
We are out of the January doldrums, which can only mean one thing. Tax season is upon us. And first things first, when can I start filing? Well, the IRS is already accepting returns. The first day was January 29th, and it's never a bad idea to file early. The earlier you do it, the earlier you might get your tax refund. Now, the IRS is racing for more than 146 million individual tax returns. Yes, that is a lot of forms. So when should you file? Well, the deadline to file is Monday, April 15th. And for most Americans, well, April 15th is also the absolute last day to request an extension. So no stress, you can just ask for an extension, right? Well, yes and no. Remember, an extension buys you additional time to file, but not more time to pay. But it could help you avoid a potentially hefty penalty. Even if you get a 6-month extension, you still need to submit any outstanding payments by tax day. Now, a tax extension can also push back contribution deadlines for some small business retirement plans, solo entrepreneurs, or heck, even freelancers. Importantly, you can get an automatic extension if you were hit by a natural disaster, are a member of the military that qualifies, or if you worked or lived outside of the U.S. on tax filing deadline. So what happens if you just miss the tax deadline? Well, you will pay for it a couple of different ways. First, there's failure to file, if you don't file your tax returns by the due date. Then there's also failure to pay, and this applies when you don't pay the tax that you owe by that due date. So what else should you consider? Your deductions. That's what you can subtract from your taxable income. You can opt for a standard deduction or an itemized one, but you need to be able to do some math to figure out which one makes the most sense for you. The standard deduction is a preordained subtraction that you can make when you file. It's adjusted each year for inflation. The standard deduction for tax returns filed in 2024 is $13,850 for single filers, $27,700 for joint filers, and $20,800 for heads of household. Itemizing, it is more work, but it can be worth it, especially if you want to include things like medical expenses or charitable donations. Credits are also critical, with the child care tax credit chief among them. You are eligible for the full credit for each qualifying child if your annual income is not over $200,000 or $400,000 in a joint filing. That is as long as you meet all the other eligibility requirements. Don't forget the earned income tax credit for workers with low to moderate income and the lifetime learning credit for those that are still in school. There certainly are lots, but stay on top of it. In 2022, the IRS sent letters to over 9 million families potentially eligible for these credits, and many others that did not claim them. So what else do you need to know? Well, recent legislation also plays a key role, maybe bigger than you realize. The Inflation Reduction Act could impact your tax bill. If you've been making your home more energy efficient, or you finally bought that Tesla that you've always dreamed of, well, it could actually save you money on your taxes. And remember, unlike a deduction, a credit cuts your tax bill directly. So take the time to figure out what you can claim. There's lots to think about in the coming months, and Yahoo Finance will be with you every step of the way.
For a data-dependent Fed, the next economic reading arrives this week, CPI. Meanwhile, markets already expect the Fed to hold rates steady in March, but a rate cut in May remains in play. For a further economic read, plus much more, I'm joined by Steve Pagliuca, who is the Bain Capital Private Equity Senior Advisor, PAGS Group founder, chair, and CEO, and co-owner of the Boston Celtics. You've certainly got a busy slate of events taking place here, from the economy all the way into what impacts your other investments in the Boston Celtics later on this week. We'll touch on that later on. But as we teed up this conversation, Steve, I'm wondering from your perspective, if there is one specific point where data can certainly shift this Fed's mind about the pathway and the pace of rate cuts.
Well, data is always an important factor. I think that the data right now is this kind of wait and see. I think you have to step back from the whole situation and look at the fact that in the last 100 years, T-bill rates have been more 4 to 5% range. And it's really only been anomalous since the crisis in 2008 that we've seen, 1%, 0.5% interest rates. So we're more in what is, I say, a normal band of interest rates than unusual. So I don't see them going down anytime soon. And I think they're going to have to watch to see if the economy is getting overheated. And we've had such an increase in the money supply. I think we're talking about a long-term, walk back of quantitative easing, which probably would necessitate interest rates at those kind of levels for a long period of time.
You're talking about an even higher for longer. Do you believe that the markets have actually priced that in, or have kind of that reality check baked into this number yet?
Well, it's not clear. I think there's some over exuberance around cuts, and people have seen lower interest rates. But again, I think if they look at history, that's an anomaly. And actually, corporate earnings and profits look like they're coming out very strong. So low interest rates, as you know, fuel speculation, and that's what got us into kind of the bubble. I think we needed to do it to get out of the crisis, but now I think it needs to be walked back over a long period of time.
How is this earnings season, as you were mentioning earnings, and there's been so much focus on where margins really stand over the course of this earnings season. How has this earnings season held up thus far from your perspective?
I think very well. Companies are reporting, good growth, good earnings, and the United States is probably the most stable economy out there, and what I would say is the most global turmoil we've seen since the 50s, with the war in Ukraine, the war in Gaza, the China decoupling. So I think the U.S. has been kind of a safe haven for investments.
And so with that in mind, that global equation that you were laying out, there's a lot of focus later on this year with a record number of people heading to polls internationally. And here in the U.S., it could reshape, or at least give us some further indication of how our international relations will also overflow into and impact the business world as well in corporate America. What is the key thing that you're watching in this, what is expected to be an extremely vitriolic 2024 general election?
Well, unfortunately, we've been in a period of a lot of vitriol in the last 20 years. There's been a market change since the elections in the 80s and the 90s in terms of mudslinging and just the whole process. We've had that before in America, so it's not new. There've been very bitter elections in earlier country's history. But we've gone into a period of polarization, which I don't think is good for America. And so I'm hoping we'll come back to some sanity in the middle, where people go to Washington and they want to get things done that are good for people, good for the economy, and good for the person on the street. So, but right now it's become kind of a mud wrestling contest.
What are you hearing from some of the other corporate executives, and how they also are perhaps playing a role in making sure that they can do their part from a business perspective to make sure that, as you mentioned, the person on the streets feels better about their relationship with business, or their place in society, in the corporate and capitalist structure that we do have?
Well, I've seen a sea change in corporate America and just investing in general, where this generation of people realize that you can do good business and you need to give back as well. So I think corporate America has really stepped up in many, many shareable programs to support education, to support diversity. So I think we're in a good trend in that area. And my overall belief is that corporations, universities, and governments need to work together so we can all prosper. Each having a divisive approach or doing something different doesn't get us anywhere. So I'm hoping, again, we're going to get back to a period where people realize it's much better to be cooperative, to work together so that everybody can prosper, rather than having political sound bites to get elected on a short-term basis.
Certainly. You know, I wonder from your perspective as well here, we got to talk a little private equity. Do you believe that there's going to be perhaps an overexuberance even about AI in private equity that continues to move forward, or is there another hotspot that you see emerging?
Well, I think you have to separate two things out. In kind of really high growth markets, you remember the internet in 1999, people were signing term sheets in 5 minutes to invest in internet companies that would do anything. There's overexuberance in these very hot growth markets. But needless to say, AI is as big as the internet, maybe bigger in terms of productivity. So there's going to be a lot of winners and losers. But in general, it has the ability to help transform and productivity in the economy over the next 10 to 20 years. So it is a very interesting area to invest into. But you've got to do that with realistic valuations, and some of the valuations are out of control right now.
Does that make some of the smaller unicorns, maybe even decacorns, more attractive or less attractive than, you know, the big mega cap tech stocks that have, and companies that have, you know, hordes of cash piles to throw at investing in either growing something up homegrown or themselves perhaps going and buying out one of the smaller players?
Well, I think it's going to be an interesting fight out there because the small companies can be backed by the large ones. They can be backed by venture capital. So there's plenty of capital that will chase great ideas, and AI is certainly one of them that will improve productivity for everyone. So there'll be a battle. I think the corporates will have some success. I think the venture capitalists have some success, but that's what America's about. It's about competition, and the best companies will win. I think this is going to be a little different than the internet because those companies you mentioned, the Magnificent Seven, most of those are natural monopolies. I don't see AI being a natural monopoly. I think there's going to be domain AI programs, language models that focus on different industries, medical, technology. And so I think there's going to be more room for many of the avenues to succeed rather than having a one network effect company that dominates everything.
Steve, just lastly, while we have you, we got to talk a little Celtics here. I would be remiss if we didn't bring up and recognize one of your players, Jason Tatum, going to his 5th NBA All-Star appearance. You know, the significance of that for the franchise, but also you think about how much for the sports world. We've seen a lot of deal making taking place over this last year. Where does that continue to move from your purview?
Well, deal making happens for two reasons. There's some franchises are sold because the owners have estate issues and they want to sell out. Also because of the promise of sports. So sports is definitely the unifying programming that gets the largest mass audiences. And in a world where we've now seen fragmentation of media viewing into streaming, digital viewing, it's a whole different world right now with many, many options out there. What is the unifying force? It's content. It's compelling content. So the internet companies want that content. The old broadcasters want that content. Streamers want that content, which makes the NBA and sports very, very valuable.
With that in mind, just lastly, while we have you, do you think there's a mega deal that's going to finally come through in the streaming landscape, knowing how much sports have really been kind of the crown jewel, perhaps for some of that viewing to remain consistent?
Well, you know, if you look at the history of television programming, we've gone through phases of bundling, unbundling, rebundling, skinny bundles. And so we've been in a big phase of unbundling with streaming coming in and the internet players coming in. And so I don't think you can support the average consumer can't belong to 15 or 20 streaming services. And so you're going to see different types of approaches, and there probably will be some consolidation necessitated by the economics of the inability to keep up all those services for all those consumers and invest in a new program for that. So I think you'll see consolidation in the coming, 3 to 5 years.
All right. Steve, thanks so much for taking the time here today. Steve Pagliuca, Bain Capital, private equity senior advisor, Pags Group founder, chair, and CEO and co-owner of the Boston Celtics. We appreciate it.
Great to be here.
We got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. TKO shares edging higher this morning after Jefferies initiated coverage of the entertainment platform, kicking it off with a buy rating and $120 price target. The firm saying that TKO is well positioned thanks to its deal with Netflix. Sponsorship, growth, and live events as well playing into that overall kind of viewpoints that they have on TKO as well right now.
It's true, really leaning into that demand for live sports and that sort of content, and especially as more streaming services getting into the mix as well. When you think of Amazon with Thursday Night Football, Apple with the MLS and Friday Night Baseball, and of course the merger of some of these streaming services here with some of these skinny bundles. But it's interesting that they see them really feeding into each other. The WWE, which is one of their assets, and the other one, which is the UFC. So you basically have these sports entertainment. I mean, depending on how you define sports.
You're not going to get me in that conversation.
UFC, in terms of the purer play when I think of sports, but then sports entertainment when I think of WWE. But the way that they can feed into each other, when you think of, especially the size of the viewer base of the WWE, ending up being a win-win according to this note.
I said I wouldn't let you get me into this conversation, but I'm going to do it anyway. Look, mixed martial arts, that is artistry at the end of the day. WWE is a scripted series. Let's be real. At the end of the day, one of the huge things that we're going to watch, though, with both of these entities is how they play out in this streaming landscape. Huge deals that they've been able to get going forward, both Netflix and as well on the social media platform X, formerly Twitter. And one of the huge things that they point out within this is they believe that TKO deserves a peer multiple, currently trading at 12 times EBITDA versus peers at about 16 times. So one of the huge things, they're looking across the margin profile, free cash flow generation, and backlog of catalysts. That's going into their multiple thesis here as well, too. Shares up 1%.
It's true, really talking about those meaningful media rights, saying, look, it's well positioned for healthy growth and margin performance as well. So really feeding into each other. Looks like a good pairing here.
Absolutely. Well, it's almost the end of the hour here. Time for a quick check of the markets as we're taking a look at the Dow, the S&P 500, and the Nasdaq. All right, there we go. Making some sense of things. Right now, we're higher by about 0.1% for the Dow and the S&P 500, Nasdaq Composite up by about 0.4%. We'll be generous and round that off too. That's it for us today, but we'll see you back here tomorrow. For Brad, Rochelle, and the entire team, bye.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita, and here is what I'm watching this hour. A new addition to the growing list of deals for the energy space, Diamondback Energy merging with Endeavor Energy Resources in a deal valued at $26 billion. We're going to be discussing what this means for the oil patch straight ahead. Meanwhile, troubles with regional lender New York Community Bancorp replacing commercial real estate back in the hot seat, with investor worries highlighting why apartments could be the next area of concern. And shifting to the EV landscape, Rivian giving up some of last week's gains after a downgrade on the stock from Barclays. We're going to hit on why Wall Street is getting bearish on the EV maker. But first, let's do a check of where the markets are trading 90 minutes into the trading week. And we are seeing green arrows across the board so far. The Dow up 58 points, the S&P 500 up 7, and the Nasdaq up 51. Remember, all three majors coming off of their fifth straight week of gains, and the S&P 500, of course, on Friday, closing above that 5,000 level for the first time in history. Let's take it where Treasury yields are right now on the back of some economic data coming up later this week, particularly around inflation. We are seeing the 5-year yield down just slightly there, the 10-year yield at 4.19 and the 30-year yield at 4.39. Well, key inflation data and retail sales, the big focus for investors this week, along with a slew of earnings, including Airbnb. Those numbers expected to give a good snapshot of the state of the consumer. Our next guest says the current economic landscape presents a Goldilocks scenario, but he warns about complacency kicking in. Let's bring in Anthony Siccaro, Providence Financial and Insurance Services President. Anthony, good to talk to you today. So talk to me about the landscape you're seeing right now. What's the concern here about investors getting a little too complacent with how things are?
Yeah, it certainly is all about the inflation numbers, which the inflation numbers then trickle back to the interest rates. And the stock market has presumed that the Federal Reserve is going to raise interest rates in March, and that's pretty much almost off the table at this point. And you would almost think that that would be negative for the stock market, but then corporate earnings have been so strong and consumer spending is still up and the labor market is still strong that, you know, the stock market has reached new record levels, despite the fact that the Federal Reserve is probably not going to lower interest rates nearly anywhere as much as they were anticipated to at the beginning of the year. What consumers, I think, the concern that I have is that consumers might be getting a little ahead out of their skis. We get to a point where we start to feel like no matter what, the stock market's going to go up. And there are a lot of consumers out there that are believing that the stock market is a safe haven. It's almost like the new safe asset class, and it will always go up. And that's not the case. There are long periods of time, decades, where the market has been flat. And those periods of time are followed by good decades, like the last 13 or 14 years when the market's been up double digits. So I don't want you to get out as a consumer over your skis and get hit if we do get into another major recession or we have another decade of flat growth, not anything like the last decade.
Yeah, certainly a lot of focus going to be on earnings, but it does still feel like it is Fed policy that's going to be the big driver in the markets. We've got inflation data coming out this week. What's kind of the sweet spot you're looking at right now that will give investors confidence that things can push a leg higher, even if the Fed isn't necessarily going to cut rates until later this year?
Sure. Yeah. Well, interest rates, or rather inflation, you know, currently at 3.3%. I think if it stays in that level and it doesn't vary too much from there, that's going to be where we need to be. We'd love to see it come down. The data doesn't seem to show that it's going to come down. Year over year, yes. Month over month, no. But it does, if it stays in that area. I think the surprise to the upside could spook the market. That could be a problem and cause stock traders to want to go somewhere else to more of a safe haven. And with the yields still as high as they are, they actually have an alternative. That's something that, 2 years ago, we did not have. The stock market didn't have. So I think that would be the sweet spot when it comes to inflation.
When you talk about aligning your portfolio right now, two scenarios, which has really kind of been the conundrum in the market. Is it about the soft landing or is it about a potential recession still on the horizon, despite the economic data pointing to resiliency in the overall economy? How do you align your portfolio based on those two scenarios?
Yeah, so this recession that's never come, right? And the question is still whether it's going to come or not. If you believe that we're going to avert a recession or we're going to have a really soft landing, and I think that there's an argument for that, then you could focus on a consumer discretionary sector where individuals are, just going to spend more money. I think that's a good way to go. Maybe more growth related stocks if you believe the labor market's going to stay strong, if you believe GDP is going to stay strong. If on the other hand, you think that there's going to be weakness in the economy, then you might want to focus on more defensive sectors, maybe healthcare, maybe utilities, maybe consumer staples, something on that order. I like to focus on dividends. At Providence Financial, we focus on dividend income regardless of what age you are. We specialize in people that are working with or people that are retired that need income. But even if you're younger today, because interest rates are so high and because they're widely anticipated to go down, buying fixed income not only to lock in a high yield, but for a capital appreciation play could make sense as well, too. The first time in decades that that's even been available.
So how much have you been shifting up based off of that play?
Yeah, so normally a 60-40 portfolio has been kind of the tried and true mantra over the decades. Over the last number of years, though, it's been questioned, especially with the younger consumers, where it should be more equities. And I think if you're in your 20s or 30s or maybe even 40s, you could afford to have more than 60% in your portfolio of equities. But today, if you have a 60-40 portfolio, that 40% not only can lock in a higher yield, I mean, you could get a very good quality corporate bonds in 5, 6, maybe even a little higher range than that, and then potentially appreciate your capital on that 40% as well, too, where previously it was not a capital appreciation play. It was all just locking in the high yield and designed to balance out the volatility you'd have with the other 60%. So I think a 60-40 portfolio, even for someone younger today, is really a great way to go. And if you're older, you may want to shift less equities and more fixed income even.
Yeah, it's always about the timeline there. Anthony Siccaro, Providence Financial Insurance Services President. Good to talk to you on this Monday. Appreciate the time.
Thank you for having me.
Well, Diamondback Energy and Endeavor Energy announcing a merger this morning valued at $26 billion. The marriage between the Permian rivals, just the latest in a string of mergers we've been seeing in the energy patch. Let's bring in Yahoo Finance's Inez Ferre to give us more details. Inez.
Yeah, that's right, Kiko. And this is a big deal because we have been seeing over the last, I would say 6 months or so, companies since the fall, really, a slew of companies that have been announcing mergers, specifically in the Permian Basin area. And this is sort of the heartland, the hotbed where there have been technological advances when it comes to drilling and where we have seen these acquisitions happening. And I spoke to one analyst on the phone just a few minutes ago who was telling me this is a logical move for Diamondback and Endeavor, and that it is probably one of the last few big deals that you will see because there are some smaller individual players, but there have been, as I said, these bigger mergers that have happened over the last couple of months. You've got ExxonMobil buying Pioneer, you have Chevron buying Hess, and then you also have Occidental Petroleum buying Crown Rock. And what this analyst was telling me is, look, the geology of the area is very well known. You don't need that many CFOs, that many CEOs in the area. And what is happening is that with the Permian Basin, as you drill more, you get into a higher a gas to oil ratio. So it starts to become gassier. So what that means is that they're producing a lot more gas than oil after a while. And so we have seen in the market sort of an influx of an oversupply, if you will, of gas. And so when that happens, you need to lower your operating costs. So part of the reason why you're seeing this is part of the reason why you're seeing this consolidation in the space. You also had Pioneer's CEO in one of the earnings call last year talking about this consolidation that would be coming to the space because companies needed inventory. So they are really securing their drilling sites for the future, Kiko.
Okay, and as Ferre staying on top of all of those deals for us, thanks so much.
Thank you.
Well, we are watching shares of Diamondback Energy surging after announcing that merger with Endeavor Energy Resources. According to the release, the combination will create a premier Permian independent operator. You see that stock up roughly 10% now. This is the latest in a slew of deals for the energy space. And here to discuss the potential of this deal for Diamondback's future in the Permian Basin, we've got Tim Resvan, KeyBank Capital Markets Managing Director. Tim, Inez just walking us through the slew of M&As that we have seen in this space. How does the one announced today rank in the bigger picture?
Well, I think when you look at from the buyer's perspective, Diamondback is almost doubling from this acquisition, so it's extremely transformative. Exxon buying Pioneer, it doesn't have the same impact to Exxon, so it's really a tremendous deal. A couple of things to point out, I think Inez had a lot of the points correctly. The cultural fit here is really important. These two companies are headquartered literally across the street from each other in the very big small town of Midland, Texas, so integration should go pretty well. And as far as the stock price performance you're seeing today, in our view, it's warranted. The market is putting a pretty clear correlation between size and trading multiple. So the extent that Diamondback is nearly doubling its size, it warrants, if you assume a good integration, it warrants a higher multiple, all else equal.
So Tim, you highlight the cultural similarities between these two companies, given where they're both based right now. How do you think about the overlap? I mean, to what extent does this make sense given how both companies operate right now?
Yeah, I mean, Endeavor's biggest asset, most of the company, is what they call core of the core rock in the eastern flank of the Permian in the Midland Basin. And when you look at the acreage positions of the two companies in the most active, most productive areas of the Permian Basin, it's areas called Martin County, Midland County, just huge ability to kind of put together these acreage positions. So there is natural sort of geologic sense. And Diamondback, part of its reputation has been as a company that's been low on the G&A side, low on the cash OpEx side. So that model overlaid on Endeavor, should drive incremental free cash flow. And that's part of the synergies that are being cited in 2025.
How big is the regulatory risk for this one? Should investors be concerned about approval?
Yeah, I'm not a regulatory expert, but the FTC has clearly been, fairly antagonistic, towards energy mergers. Pioneer and Exxon have, I believe, they've been asked to provide more documentation on that merger. But the Permian remains, a fertile activity area. There are literally dozens of operators there. So it's hard to view any sort of monopolistic kind of powers that would be derived from this merger. So I'm sure that the FTC will create some work for the lawyers, but we don't see that stopping the deal.
Tim, you've already got an overweight rating on the stock when it comes to Diamondback, price target of $170 a share. I mean, we're inching closer to that already. If you sort of expect a smooth approval process here in this particular merger, do you stick to that, or you think additional catalysts can push that stock even higher?
We're not allowed to foreshadow ratings changes. I would say we're in the very early innings of reviewing our model. Our, price targets reflect inventory depth and quality, which you would assume would be all else equal going up. And then obviously valuation metrics, free cash flow generation are all sort of part of the recipe. So we'll go back and take a look at this. But I would say another important sort of driver of this deal, which we liked about it, is Diamondback is one of the few E&Ps that were up in absolute terms in 2023 in a choppy year for the market. And part of this, the re-rate in shares, was because it was perceived as a takeout candidate. So what we found pretty attractive here is the company is nimbly using that equity currency that it gained in 2023 to kind of make this deal and help it get structured attractively.
Finally, Tim, Inez sort of alluded to this land grab that we have seen in the Permian Basin, if you will. But the broader narrative in the energy space has been about where the peak is for oil and gas. You've got those like IEA saying it's 2030. Obviously, those within the energy space, plenty of disagreement on that. But can you talk to me about the two competing narratives here? I mean, on the one hand, we are seeing this consolidation happening in the Permian Basin, this grab to be able to get additional supply. And yet the counter narrative to this is also that peak is coming pretty soon. I mean, how do we weigh the two? I
would push back on this narrative that the peak in oil demand is coming soon. We would, broadly speaking, push back on anything the IEA publishes. We found them to be a pretty low credibility. We feel like there's a political agenda underlying a lot of their publications. If you want to look at what the smart, connected people are saying about oil, I would look at the Chevron Hess acquisition. I don't cover either of the names, but in our view, that clearly looked like an opportunity for Chevron to get into one of the biggest oil discoveries we've had in decades globally. So that speaks to sort of their view on peak oil demand and their interest in kind of participating in that next discovery. So I think the issue here is preserving asset quality, inventory quality. You can step down in quality and see a lot of like gassier, less productive intervals that companies will be able to drill in higher price environments. But in this sort of steady state environment, we believe this adds, degradation is a big theme in the industry with well results. And you would think that this acquisition should help Diamondback push that off for many years.
Tim Resvan, KeyBank Capital Markets Managing Director. Good to talk to you today. Appreciate the time.
Thanks, Kiko.
Well, coming up, New York Community Bank sending jitters through the regional bank sector. We're going to discuss how much investors should be worried. Coming up on the other side. Well, fears around the health of the regional banking sector are being reignited again after New York Community Bancorp's recent earnings report pointed to losses in its commercial real estate portfolio. Those struggles have put the commercial real estate market back under the spotlight. Research from Apollo Global Management, the parent company of Yahoo Finance, shows that small banks account for 70% of all outstanding commercial real estate loans. Trouble in the market potentially could mean trouble for more of these smaller lenders. Joining me now is Stan Van Nieuwenburg. He's Columbia Business School professor of real estate. Professor, it's good to talk to you today. I want to start specifically on the issue of New York Community Bancorp, because I think investors have been trying to figure out, how much of what we saw reflected in their balance sheet is specific to NYCB. How much of this is about a broader collapse, if you will, that's likely to come? I mean, you've been modeling out some of these scenarios. How do you view this?
Well, Akiko, I think that there's a broader commercial real estate issue that we're facing here, right? Most notably in the office market, where vacancy rates have been rising, rents have been falling, and loans have been coming to a head and failing to refinance over the past year. New York Community Bank has a lot more multifamily exposure than office exposure, but even there in the multifamily market, we're seeing weakness.
Let's start by talking more about the office space, because I know you've kind of been modeling out the impact from remote work. At the end of the day, this is about just the change in the way we work. We don't necessarily go into offices anymore. If you've walked around New York City, you see how empty some of these office spaces are. What does that ultimately mean in terms of the decline of the value of some of these spaces?
Right. So my research has sort of quantified that, the decline in office demands, due to the combination of remote work, but also higher interest rates, ultimately results in a loss of value of around 50% for commercial property, for office buildings, right? Which is a dramatic decline, and in many cases would wipe out the equity in some of these underlying buildings.
And when are we likely to see that? I mean, the concern is, of course, when those loans come due, the payment just isn't going to be there because of that decline in value. I mean, you sort of mentioned that, look, when you think about where tenants are right now, they are in the process of sort of figuring out what that next step should be when they have to renew the leases. At what point does this all sort of become kind of an avalanche?
Right. So, I mean, office leases are long-term in nature, right? So even today, there's still a lot of tenants that are serving out their pre-pandemic leases. But over the last 4 years, a lot of tenants have already reduced their office demand. And in a recent survey by CBRE, something like 40% of companies are indicating that they want to cut their office demand even more by a further, 30% or more in the next 3 years, right? So this is sort of a train wreck in slow motion. As these leases are coming up for renewal, a lot of tenants are deciding not to renew them. That causes cash flow issues for the landlords in these buildings. And eventually, when that mortgage comes due, they may not be able to refinance that mortgage.
Who's most exposed right now in that scenario?
Right. So there's about $6 trillion of commercial real estate debt outstanding. Banks own about half of it. And we know that smaller regional banks own like 70% of all that bank commercial real estate exposure. So that's sort of a natural place to look at smaller regional sized banks like New York Community Bank, but also other banks like Valley Bank, for example.
You mentioned multifamily units, certainly a sort of the next concern that investors are watching. What does that scenario look like right now?
Right. So multifamily is a little different because, of course, it's not related to remote work. But, like the office market, it has also experienced this, sharp rise in interest rates over the last 2 years. And then we need to remember that multifamily was really red hot in 2021 and 2022 with something like $650 billion of total sales of apartment buildings at record prices. So, there was a lot of froth in the apartment market. A lot of those valuations were premised on ever increasing rental growth. And that rent growth has now basically stopped, or at the very least slowed down. So a lot of those valuations now look frothy in the new environment with lower rent growth and with higher interest rates. And again, when those loans, that finance these properties come up for renewal, many of them will have difficulty refinancing.
What does that ultimately mean for the landscape of major cities in the U.S.? Obviously, New York City, a big focus, San Francisco, another one that gets named a lot. The use cases changing, obviously the tenants starting to move out. You're talking about some of these, multifamily units also, that changes as well. I mean, what these buildings that are currently standing, what ultimately becomes of them?
Look, I mean, I think there's sort of a tale of two stories here, right? So New York City still has a lot of shortage of housing, like many cities do. If apartment rents come down a little bit, that would be good news for renters. The office building landscape is different. We have too much office, and because of those secular changes in remote work, we probably need to convert a good chunk of that office space, right? And that's what the conversation has been about in places like San Francisco and New York, but in many cities, right? We need to repurpose some of that existing office stock into something else, housing being just one example.
Stan Van Nieuwenburg from Columbia Business School. Professor, it's so great to talk to you today. Really appreciate the time. All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, Chevrolet releasing new prices for the base model of its Equinox EV, making it one of the most affordable electric cars on the market. For more on this, let's bring in Yahoo Finance's Praz Subramanian. Praz, I guess the question is the price point enough to get this next wave of EV drivers on board?
Yeah, I think it's good to kind of get these more details here on that pricing. We had heard in the fall that that entry-level Equinox EV would sell for about $35,000. Now we have confirmation that dealer ordering is expected soon, now with official pricing. So that entry-level 1LT you mentioned, that'll start at $34,995 with availability in the fall. GM targeting 319 miles of range for, which is pretty impressive. Higher in terms of the 2LT start at 44K, with the range topping 3RS starting at around 47,000. But it's that base model, like you mentioned, at 35,000 that's very compelling because it does qualify also for the federal EV tax credit, meaning it could be had for around 28,000, not including delivery. The big question is, of course, how much money is Jim making or not making on this EV? But I think, Kiko, you're right. I think it will sort of move the needle for that, finally addressing that lower end of the market that supposedly wants an EV but just can't afford it at these levels.
Yeah, I mean, speaking of affordability, Tesla cutting the prices of some of its cars, Model Y specifically, yet again here. What is the strategy and what kind of cuts are we talking about?
So when I first read this, it sort of kind of caught me as Tesla's taking a page out of traditional, manufacturers' sort of incentive plans. So they offer like 2 weeks only, get X amount of money off, or new financing for an F-150 through the end of April, that sort of thing. So right now what they're saying is through the end of February, you get $1,000 off a Model Y, and then after that, the prices go back up. So kind of an interesting page there to do this short-term incentives, which is such a big part of traditional automakers' incentive plans. I will say that, though, it is kind of funny or interesting to have that end-of-month mid-quarter incentive. Maybe there's some softness that Tesla's seeing in the Model Y sales right now, or just sales in general. But at this point, a new Model Y RWD for around 43K before tax credits, which it does qualify for, is a pretty good deal for that. We're not talking about the Chevy Equinox. We're talking about a bit of a higher level car in terms of features and potentially sort of specifications.
Yeah, all of this, of course, points to just how much competition there is increasingly in the EV space. Pras Subramanian, as always, thanks so much.
Thank you.
Well, Cisco cutting thousands of jobs this weekend. And according to layoffs.fyi, in the tech sector alone, more than 34,000 people have been laid off so far this year. That's just scraping the surface. Over 42,000 people and counting are being cut in other sectors like financial services and manufacturing, according to Reuters. For what this means for the future of workers, let's bring in Anna Tavis, New York University clinical professor of human capital management. It's good to talk to you today. It feels like we're increasingly hearing in these announcements, whether it is the tech announcements or those outside of tech, it's about efficiency, automation. I mean, is there a thread that we can point to beyond just overhiring that happened during the pandemic?
Yes, Akiko. Overhiring is going to be finding the reasons for this realignment looking back. Definitely in the pandemic, there was a lot of hiring, a lot of jobs, opportunities, specifically in the tech sector. And these are the companies, as we all remember, that went remote first and were celebrating remote work. Looking forward, however, I think there's a whole range of new reasons why companies are making these drastic decisions and cuts. And that has to do with, again, as you mentioned, efficiency, productivity, and the need to introduce efficiency tools and really quickly realign around AI and other types of technologies that are really replacing those very remote workers who have been kind of dominating the market before. Because we can look internally as to what the companies are doing to execute on these layoffs, as well as externally the dynamism of a market, whether there are other opportunities for those workers to move in and get new jobs and transition into new industries.
Adam, let's pick up on that point, because there has been an ongoing conversation about the concerns about artificial intelligence and what that ultimately means for the labor market. If you look at the cuts that have been announced so far this year, how much of them have been replaced by AI? How much of this has been about cost cutting that will ultimately lead to investments to introduce additional AI technology?
I think this is sort of a combination of both. It's a hybrid. Clearly, cost cutting is the immediate need for companies. Because according to PwC survey of CEOs, we know that productivity is number one concern for all of these, senior executives. And the most immediate and obvious place to look to cut those costs will be headcount. However, those companies that are more strategic, and I would put technology companies into that group, are looking ahead just as much as they are trying to catch up on inefficiencies of the last cycle. And looking ahead is Meta, for example, I think is a good example, is one of the best examples of how to do a strategic realignment, because they've been working on these layoffs for over a year, looking internally and strategically carving out those areas where they needed to cut. So I would say it really differs from company to company, but those that are making those changes strategically are definitely looking more ahead than looking backwards to the times when they overhired.
When you think about jobs that have been affected traditionally by automation, we think about factories and warehouses, sort of the so-called, quote, unskilled labor. Now that we're talking about integration from something like generative AI, who's most vulnerable?
I think no job is, is safe at this point in time. Even, I know there are some projects going on calculating the partial automation of CEO jobs and senior executives. I think augmentation of every job with technology is what companies need to be looking at. And then obviously investing in reskilling their workers. Where I think the layoffs fall short is, again, they are underestimating the amount of work that still needs to happen, and that they need to be retraining their workers, which will be a lot more cost effective than going a traditional route and laying off thousands of skilled workers and oftentimes technology workers who are, project management, operations, those jobs that they think they're going to be able to replace with the tools, but we know that this is very short-sighted. So companies that are doing layoffs right are actually investing just as much into the reskilling of their jobs than just, creating an immediate rush and the spike in through cost cutting, rather than looking strategically and transitioning their workers into the space where there's more shelf life and longevity to their skills.
Anna Tavis, New York University clinical professor of human capital management. It's good to talk to you today.
Thank you so much, Akiko.
Well, earnings continuing to be a big driver for the market, and names like Airbnb are set to report this week. Here's a look back at how the company got here.
Although it just went public in 2020, Airbnb has already built itself into the go-to choice for short and long-term homestays and experiences. Airbnb's gross profit in 2023 was nearly $8 billion, more than a 20% increase year over year. Let's take a look at what led to Airbnb's boom with Beyond the Ticker, where we dive into some of the company's biggest moments. In 2007, Brian Chesky and Joe Gebbia created the initial concept for Airbnb. 1 year later, the airbedandbreakfast.com website launched, renting out 3 air mattresses within their San Francisco loft. In 2009, the website shortened to Airbnb.com and expanded from airbeds and shared spaces to a wide variety of properties. Later that year, Airbnb raised $585,000 from Sequoia Capital in a seed round, valuing the company at $2.4 million. By 2011, Airbnb announced it hit 1 million bookings on its website and reached unicorn status. The privately owned startup was now valued at $1 billion. Airbnb completed a redesign of its site and mobile app in 2014, including the new Bello logo. Later that year, San Francisco voted no to a measure to restrict Airbnb rentals in the city. The company spent more than $8 million in its ad campaign in the lead up to the vote. Since 2016, Airbnb has expanded through several strategic launches and acquisitions, including Trip for Real, Airbnb Experiences, Luxury Retreats, Nido, Airbnb Plus, and Hotel Tonight. On December 10th, 2020, Airbnb went public via initial public offering at $68 a share, raising $3.5 billion. The company was valued at $47 billion. With plans to expand its AI services, Airbnb acquired GamePlanner.ai in 2023. Airbnb CEO and co-founder Brian Chesky said, Airbnb is one of the more humanistic companies in technology, and I believe that we can develop some of the best interfaces and practical applications for AI.
Well, Yemen's Houthis claiming credit now for the recent attack on a U.S. cargo ship, the Star Iris. That ship was bound for Iran and is just the latest attack disrupting trade in the Red Sea. Major corporations like Maersk warning there have been no signs of improvements and will continue to reroute their shipments from the Suez Canal. Let's bring in Matt Minstar. He's Breakthrough Chief Economist. Matt, good to talk to you today. Give me a sense of the lay of the land right now in the Red Sea. I mean, there have been some reports that suggest that the attacks have started to scale back since the U.S. and the U.K. went on the offensive in response to some of those attacks we saw several months ago. How do things look?
Thank you. I think you summed it up really well. There's not a sense of great improvement in the Red Sea right now. It will take an extended period of time of improvement for there to be confidence among major corporations shipping, moving their freight that would normally pursue with their freight through the Red Sea and out through the Suez Canal, or vice versa, to reroute and change their services to bring them back if they are rerouting freight from the Cape of Good Hope to return to that preferred method of transit. It's going to take some time.
When you consider the importance of the Suez Canal in global trade and the disruptions we're seeing right now, where are the biggest pain points being felt?
Largest pain points right now seem to be hitting those major corporations of container shipping, real prominent brands in the tanker shipping industry that have chosen to move most, if not all, of their freight around the canal, that are rerouting around the Cape of Good Hope and ultimately choosing to take this destination to keep their crews safe, to keep their cargo safe. Ultimately, that's a profound impact. Also has an impact on the cargo owners whose freight are now moving around the Cape of Good Hope. This is a massive transportation disruption. It does matter substantially to transit times. It's adding 10 to 12 days in some instances. It is coming at an increased cost. There are surcharges that are being put into place to accommodate for this conflict disruption. It's an added cost that cargo owners weren't accounting for at the beginning of this year. And ultimately, it impacts both those carrying the freight as well those whose freight is being carried now around the Cape of Good Hope.
Yeah, when you talk about those increased costs, I mean, what industries are seeing the biggest jump in that? And how much of that ultimately down the line gets passed down to the consumer?
This has been a question that's been given a lot of consideration. I will say there is disruption to transportation. It does come with increased costs. One of the increased costs, even through emissions, the European Union's emissions trading system kicked off for maritime shipping earlier this year. That has an added cost as we've increased our transit time. There are more emissions that come from the Cape of Good Hope. Ultimately, though, what we've seen played out is a doubling of what we call spot or near-term rates from December to January for a lot of freight. What's also true is that a lot of cargo is not carried on near-term rates. It's in longer-term contracted rates. So we think about what industry and who's impacted. It's particularly shippers or cargo owners who are very much relying on near-term rates to move freight. Can be smaller cargo owners. Many of your larger multinational corporations are going to be in these longer term contracts and just won't have their products subjected to this kind of cost inflation from a disruption, even of this magnitude. It also happens because we're talking about massive economies of scale, whether we're moving refined products in tankers or containerized freight consumer products on container ships. The economies of scale take a lot of this cost increase and make it negligible, particularly in the face of what we experienced during the pandemic. It just doesn't match up. And so while there is an impact to both the carriers to need to ultimately meet the higher costs and pass along the higher costs of changing their transit and changing their services that they're providing to cargo owners, and there's a higher cost to the cargo owners as a consequence of that. It's just not being something that's substantial enough to make an impact downstream to consumers at this juncture. Just not out of a similar scale to the pandemic.
Yeah, I mean, that's important context because there's certainly a lot of people who've been watching this saying, is this kind of a repeat of what we saw during the pandemic? What's been the knock-on impact to air and rail freight? Because we have seen plenty of reports out there about companies who are trying to sort of, put the puzzle pieces together right now and saying maybe shipping is not the best option given the uncertainty in the Suez Canal.
There's a near-term logistical shuffle that's unfolding, that for the time being, we see increased rates in maritime transportation. There's more capacity that will be deployed to help offset some of those rate increases and ultimately the pressure it's placed on service times. As you mentioned, there is an increase that's being experienced for air freight. rates are increasing. They're receiving some pressure. There are more volumes going to the air as transit times and services downstream need to be met. Products need to arrive where they need to be when they need to be there. Ultimately, when you talk about inland distribution, this is one of the reasons why this inflation impact of the Red Sea disruption won't touch the experience of what we had during the pandemic. Is ultimately, it's very much an international movement of international shipping cargoes, air freight. We've seen rate increases. There's some overland rail increases. But as the freight gets to the domestic United States, there are some benefits perhaps coming on the West Coast, but our intermodal freight demand had been so low in 2023 that this is just a subtle boost for the industry in terms of its total freight volumes. So it has the capacity available to accommodate any increases to the West Coast, and there isn't. We're not seeing much of a budge in terms of the rate for intermodal services. We're not seeing that price per mile increase.
Really important insight there. Matt Minster, Breakthrough Chief Economist. It's good to talk to you. Thanks so much.
My pleasure. Thank you.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Consumer staple stocks in focus this week, with Kraft Heinz and Coca-Cola among the companies set to report results. Yahoo Finance's Brooke DePalma is here with a preview. Brooke.
Good morning, Akiko. That's right. Many household names, one that all Americans know very well in their cupboard, are set to report this week. And some of those we're taking a closer look at include Molson Coors, waiting to see if that company continued to gain share after Bud Light lost its market share in the latter part, or rather beginning throughout 2023. Coca-Cola, many expecting low single-digit volume growth there. WK Kellogg, now this will be the second earnings report for that company since it split from Kellanova, but many wondering how exactly they could buy in. Well, earlier today, Bank of America analyst Brian Spillane told Yahoo Finance that he's seeing investors be a little bit more selective on buying into the sector as a whole. But when high-quality stocks stumble, well, investors seem to be buying in then. He shared some of his top picks as well. Take a listen.
Within beverages right now, we're actually Coke over Pepsi. And again, it gets back into this, we think Coke has a year where they'll have sort of a higher quality top line, both in terms of balance between volume and price mix. And among the center store packaged food companies, we still like Kraft Heinz, sort of best in class in what is, somewhat of a challenged block.
And another analyst telling Yahoo Finance that Coke and PepsiCo have long-term competitive advantages over the sector in the next 20 years, over their rivals rather in the next 20 years. And Kraft Heinz continues to be one to watch among many analysts on the street. And so we'll be keeping a close eye on that one as well.
What's the outlook for the sector overall, Brooke?
Yeah, Akiko, well, the sector continues to underperform the S&P 500 quite significantly. And there are four things that I'm really watching when it comes to the consumer staples sector is volume growth here. Are consumers pulling back on just how much they're buying with those laps of both price hikes taken in 2022 and 2023, particularly for Kraft Heinz? I'm taking a closer look at promotion levels seen last year and if those worked to get consumers enticed to buy more. Food away from home continues to outpace the price of food at home. Of course, with the CPI out tomorrow, that'll be something to watch when it comes to the sector. And also, Akiko, I'm watching the impact of those conflicts that we continue to see in the Middle East, particularly how it's weighing on Coca-Cola. So those are just some of the things that might impact the sector as a whole.
A busy week ahead for you, Brooke. I appreciate you breaking that down for us. Let's do a final check of the markets before we let you go as we head into the noon hour. We are seeing all three major indices here sort of holding all in the green right now. The Dow up 214 points. The S&P 500, by the way, hitting a fresh high in the session, up 20 points here. And the Nasdaq up 75. That does it for me in this 11 to noon Eastern hour. But we've got much more to come here on Yahoo Finance. Keep it right here.